Let me walk you through something that happens more often than it should. A customer calls their bank on a Tuesday afternoon and asks to revoke their marketing consent. They don't want their data used for campaigns anymore. The customer service rep takes the request, the preference center updates, and within a few minutes, the customer gets a confirmation email. From where they're sitting, that's done. From the bank's front-end logs, that's done. But consider what's still running in the background. The marketing automation platform runs its nightly batch sync at 2 in the morning. Until that job completes, the platform still holds the customer's old consent status, and it may still be qualifying them for outbound campaigns. The analytics system runs its daily data pull on Wednesday morning. It's drawing from a replicated data store that hasn't received the updated consent flag yet. And there's an open banking API that's still serving that customer's account data to a third-party provider on Wednesday afternoon, because the provider's access token was issued under the original consent, and nobody's revoked it at the gateway layer yet. Each of those is a potential compliance violation. Not because the institution acted in bad faith, but because the consent record and consent enforcement are two different things. And most CIAM architectures treat them as the same thing. So why does this happen? The answer is architectural. Most CIAM platforms treat consent as a data attribute, a flag. It's stored in a user profile or a preference database, and when the customer changes something, that flag gets updated, and the platform sends a notification downstream. Those downstream systems, the CRM, the marketing tool, the analytics platform then consume the update on their own schedule. In a batch sync model, that schedule might be overnight. In an event-driven model, there's usually delivery uncertainty, retry logic, processing queues. Either way, the result is the same. For some window of time after the revocation, downstream systems are still acting on a consent state that no longer exists. This is what we call a consent storage architecture. The consent record is central, but enforcement is distributed. Each downstream system becomes its own independent interpreter of the consent state. And when those systems are on different update schedules, which they almost always are, you get a window where the official record says revoked and the actual processing says otherwise. In a simple environment, that window might be manageable. But in a financial institution with a CRM, a marketing automation platform, an analytics stack, an open banking API layer, and possibly a third-party data aggregator, you have 5 or 6 independent interpreters, each with their own sync schedule, each representing a potential gap. What the alternative looks like. The architectural alternative is to enforce consent at the point of authorization, rather than distribute it downstream. In this model, consent isn't a flag that downstream systems query on a schedule. It's a policy condition that gets evaluated every single time a system requests access to a customer's data. When the marketing platform tries to qualify a customer for a campaign, it doesn't check a cached copy of the consent flag. It hits the authorization layer, which evaluates the current consent state in real time and either permits or denies the request right there. The Tuesday afternoon scenario plays out very differently. Customer revokes consent at 2:47 p.m. From that moment, any downstream request for that customer's data is denied at the policy layer. There's no propagation window. And because the authorization layer made and recorded that decision, there's a native enforcement record, a time-stamped log showing exactly what was permitted or denied under what consent state at the moment it happened. That's the record a regulator asks for, and it either exists natively or it doesn't. The 4 external identity types. Now, there's a second dimension to this problem that often gets missed in CIAM evaluations. Most platforms are designed for one type of external identity, the retail customer. The person who opens an account, registers for online banking, logs in from their phone. CIAM demos are almost exclusively built around this use case. But financial institutions don't just serve retail customers. They manage 4 distinct external identity relationships, each with different access requirements, different lifecycle patterns, and different governance expectations. There's the retail customer, the core use case, handled well by most platforms. There's the corporate banking client, a treasury team, or a finance department that needs delegated administration within the bank's platform. The corporate client's admin should be able to manage their own users within a policy boundary set by the bank. Most authentication-first platforms have no native mechanism for this. There's the open banking partner, a fintech or TPP accessing account data under PSD2, or a comparable framework. This isn't just an authenticated API consumer. This is an identity with a governance lifecycle, onboarding under a regulatory status check, ongoing access within a consent scope, and access revocation when the relationship or their regulatory status changes. And there's the regulated third party, insurance partners, payment processors, data aggregators, each with their own access rights, audit obligations, and offboarding requirements. A platform that handles the retail customer well and treats the other three as edge cases requiring custom development is not a complete solution for a financial institution with any complexity in its partner ecosystem. The audit question. Regulatory examinations in financial services are increasingly operational in character. An examiner reviewing consent compliance isn't going to stop at, "Do you have a preference center?" The question they ask is this: if a customer revoked consent on this date, can you demonstrate that all data processing stopped, and can you show us the evidence? For most institutions, answering that question requires manually pulling logs from the CIAM system, the CRM, the marketing platform, the analytics database, and the API gateway. Each one has its own log format, its own timestamp conventions, its own definition of a consent event. Reconstructing a coherent picture across all of them isn't just time-consuming, it's fundamentally unreliable. Because those systems were never designed to produce a unified enforcement record together. That's the audit finding waiting to happen. Not that the institution violated consent deliberately, but that it cannot demonstrate it didn't. If you're evaluating CIAM for a regulated financial institution, or reviewing what your current platform actually does when a consent revocation happens, OpenIAM's approach to this problem is laid out in detail on the CIAM for Financial Services page. It covers the authentication architecture, the consent enforcement model, how audit readiness works in practice, and what the evaluation criteria look like for a governed platform versus an authentication-first one. Links are in the description.